On one Wednesday of almost every month of the year, the market braces itself for something called the Federal Open Market Committee meeting, basically a meeting where the Federal Reserve is going to come together and talk about monetary policy. Are they going to be rising interest rates? Are they going to be reducing interest rates? Obviously, in this current market environment, the main stance has been to rise interest rates to combat inflation. Rising rates is one of the only tools that the Fed has to combat inflation. So it's been the main tool that they've been using ever since about the beginning of 2022, where rates were at 0% and now they're up to about 5.5%. So on this past Wednesday, there was a very highly anticipated Federal Reserve meeting. And this one was interesting because just a few weeks ago, if you've been paying attention to the news, we had some banks fail, right? There was Silicon Valley Bank had a massive failure, the second biggest bank failure since 2008, where they failed after a bank run. Now, the reason they gave for this failure was rising interest rates had put pressure on their bond holdings. I made a whole video about this, and it caused them to basically go under. A few days later, Signature Bank was the next casualty of this bank run phenomenon caused by rising interest rates. So going into this meeting, people were wondering, is the Fed going to keep on pushing forward with these rising rates to combat inflation, or are they going to be concerned that rising rates are going to keep on causing these banks to potentially fail and go under? And then sure enough, just a few days later, we had a massive bank, Credit Suisse, a bank that's massively known in Switzerland, also was bought out by their rival UBS for only $3.2 billion, which is kind of a surprising number. I thought they were a much larger bank, also citing concerns of interest rates causing them to lose liquidity. So analysts like Goldman Sachs actually expected, they said this on the Tuesday following the Fed meeting, that they no longer expect the Fed to rate hike after the SVB and other banks' failures. And this was also a stance shared by Moody's Analytics, Mark Zandi. He said that Fed is unlikely to hike rates in March given the banking turmoil. However, other people like Citigroup said, no, I think it's going to be fine. They're still going to raise rates about 25 basis points. So what does this mean for trading? Well, absolutely nothing. I know how it is. Most beginner traders and retail traders love to hyper focus on trying to analyze the news to get their stance of how to trade. But I'm telling you, in this video, I'm going to be sharing with you my strategy for how I trade on FOMC day, how I trade options on FOMC day. And this has worked 5 out of 6 times for the past FOMC meetings. Now, I know that's not a massive stat. It has worked more often than that, but I can only get proof of it working the past 5 out of 6 times with charts. And so this is going to be a very interesting video and hopefully opens up some of your eyes, because I know so many retail traders. I mean, just look at the plethora of videos talking about news and analysts and all this fluff, but no one's telling you how to actually trade. I'm here to tell you how I trade SPY on these FOMC days, all right? So I'm going to be sharing with you my strategies and my rules around how I decide whether to go long or short to buy calls or puts on these options, all right? So with that being said, option trading is super risky. If you don't know what you're doing, then do not get involved with this. If anything, practice it in paper trading before you do anything. It's very risky. You can lose all your money in an instant, especially when you're trading 0 to 8 to expiration options, all right? So one of my first rules for myself whenever I trade options, obviously the profit potential is very enticing because you can make 500 to 1,000% in a single day. But when you're trading those risky options, you can lose everything. You can go worthless very easily. If your option expires worthless and you don't manage your risk, it can go down to 0 in a blink of an eye. So for me, I never risk more than 2 to 4% of my entire account in any single options trade, meaning that I will never use more than 2% of my capital to buy options, because I always go into options with the understanding that I could just pass out, I could lose my power, something could happen where I can't manage my trade and it could go worthless. So better just to manage that risk up ahead and not even be caught in those bad positions, okay? So what I do whenever I trade SPY on these FOMC days is I do not take any positions until after the meeting comes out. Because what tends to happen is this phenomenon I call the knee-jerk reaction and then dump in the opposite direction. So typically, because most traders, right, most retail traders love to FOMO and they buy into the news and they buy into whatever the hype is in the moment, most people are going to sit around and watch the charts. And then if they see, for example, SPY starts to spike when the news comes out, they're going to assume, okay, it's good news, right? The market's going to rally. So they see a spike and they buy calls into it. But 9 times out of 10, you'll see in these charts I'm going to show you up here in a second, the market's going to reverse in the opposite direction. It also happens if the news comes out and the market dumps. People are going to chase that and they're going to buy puts, but then the market's going to reverse and run all day into the close. So instead of getting FOMO'd into that knee jerk, wait for that knee jerk to form, make your plan and play the opposite direction. That's what I did this past Wednesday on SPY, and I had an amazing trade both yesterday and today. On Wednesday and Thursday, I played the correct direction and I made a killing on SPY options. So here's the chart from this most recent Fed meeting. And you can see what I mean. You can see right here at 11 a.m. West Coast time, 2 p.m. market time. You can see market initially had the very strong reaction to the Fed. So most retail traders are going to see that and they're going to assume that, okay, this is great news, and they're going to buy calls into it. But instead, I had a level of resistance drawn off here at 401. So once I saw it spike up into that price point, I bought puts, knowing that it's likely going to dump and reverse in the opposite direction. And sure enough, once that knee-jerk trap was formed, you can see SPY dumped, bounced up, rejected view up, and then completely got obliterated into the close, down almost 10 points from the top. So that's that knee-jerk and reversal. And then here's that same phenomenon happening in February in the opposite direction. You can see once that Fed meeting news came out, the market dumped initially, so people chased the downside buying puts, but you can see it was just a trap, and then the market squeezed and reversed in the opposite direction into the close. And then back here in November, same exact thing. Once that Fed meeting news came out, the market had that knee-jerk reaction where it spiked up, trapped all the retail traders, and then it dumped in the opposite direction. You see the pattern that's happening here? Now here's September. It is a bit different because you can see it did end up dumping in the same direction into the close, but during that initial fall down, I was able to trade this and I bought calls in the upwards direction. And because I plan my trades very conservatively, I don't like to swing my entire position all the way into the close. I lock in my profits into the levels of resistance, and you can see here, there is no level of resistance right near 387. So locking in your profits into that move would have netted a very, very nice profit. And then of course, here's July. Now on Thinkorswim, I couldn't go back that far with 5-minute charts. So here's a 10-minute chart, but you can see same exact thing. Once that Fed meeting news came out, the market had dumped initially downwards from 396 towards 395, and then trapped those retail traders and pumped all the way to 402. So you can see there is that very, very common pattern. Now, of course, patterns are just patterns. They don't happen all the time. And as I said, option trading is super, super risky. Make sure that if you want to get involved with options, make sure to educate yourself and plan your risk accordingly. No trade is a guaranteed success. As I tell everyone in my community, you have to plan from a risk management perspective first. But now let's go in and dive in on the actual trades I took yesterday and today, because obviously I want to show proof that I was able to do this, not just hindsight. So here you can see the watch list I posted yesterday on March 22nd, the day of the FOMC news. And as I said, today is Fed day. The Fed meeting is going to be discussing rates at 2 p.m. Expect a lot of volatility, and ultimately for SPY, I will be waiting for the FOMC news to come out and then play the knee-jerk and reversal. If we pop off the news drop, I will be looking for puts at the 401 area, and if we dump, I'll be looking for calls at the 396 area. So exactly like I said in that picture earlier. And then finally, after the dust settled after FOMC, I notified my chat saying that I got 400 puts as SPY was touching 401. Now, I traded 0-day to expiration options as I always do for FOMC just because it has a bit better volatility. And I was able to get long them at $1.50 per contract. And I sold my first partial at $2.50 per contract. And then I just had a bit more commentary while we were seeing that sell off. And then later into the close, I sold some more into the 355 level. And then I sold the rest at 350. So just about 125% gain on most of the position for these contracts. And then here you can see my actual executions from tradervoo.com that shows the actual time of my executions overlaid on the SPY chart. So all in all, that is my basic strategy for trading SPY on FOMC day. And I kind of broke it down into these 6 key rules. Number 1, you have to have knowledge of how to trade using technical analysis, primarily using horizontal levels of support and resistance. I teach this every single day in my community and in my course, which you can click the first link down below for. And I have so many YouTube videos talking about this topic. Very, very simple. But basically, first off, mark off both directions of hourly chart and daily chart levels, and be ready to trade in either direction. You don't want to have a bias, a strict bias in one direction, because you might be wrong, right? You don't know which way the market makers are going to push the market, so don't have a strong bias. Whichever way the knee-jerk reaction goes, plan to play the opposite, okay? And then just in general for options for myself, I always like to aim to buy out of the money and then sell in the money. That's how I get the best volatility on the profits. And then number 5, take profits into known levels of support or resistance, depending on which way you're playing. And number 6 is what I failed to do yesterday. Trade both 0-day to expiration and Friday expiration. So once again, these are just rules for myself for the next FOMC meeting. But if I had done this, I would have had a good position to swing overnight and have a bit more leeway with, how I want to trade it, right? Because you can see in that last dump yesterday, I definitely sold them way too soon, right? Because I sold the rest of my contracts into this test of 396. And if I just held into the close, right, I would have made an extra, $4 per contract, because they went up to like $7 per contract. So I definitely left a lot on the table. So if I had more contracts overnight and I was able to swing them, I would have been able to profit off that dump a bit better. So obviously learning for myself too, never going to be perfect, but that's pretty much how it is. So that is my basic strategy of how I trade options on the FOMC meeting. Obviously, this is not a system that works 100% of the time. I never claim that. So be sure that you do your own research, plan your own levels, and plan your own trades appropriately. And if you do try this practice in the paper, make sure it's profitable for yourself, because everyone trades different, right? You might not have the same risk tolerance as I do. You might not have the same patience as I do. So be very careful with how you trade, okay? And with that being said, that's pretty much it. So let me know what you think about this type of options trading strategy. If you have your own tips and tricks, leave them down in the comment section below, and I'd be happy to see what you guys have to share with us. All right, that's pretty much it. If you enjoyed the video, please subscribe. I'd appreciate it, and I'll see you in the next video.